Hello, Ertan. Nice to have you here. It's a pleasure to speak with you. How are you today? First of all, in this very, very cold Luxembourg day.
I'm great. I didn't expect to be, taking a video of myself. So we have a Christmas event at the loft today.
That was a requirement to have that
Yeah,
one.
exactly.
Okay, do you want to give us a short introduction of Multiple Capital at the moment?
Sure, happy to. So I'm the founder of Multiple Capital. Multiple is a fund of funds focused on what we call micro VCs. What is a micro VC for us? A micro VC is a fund between 5 and 50 million in fund size. And we tend to invest somewhere in the middle. So the average is around 20 million in fund size. We believe that data shows over the last decades that smaller funds in venture outperform larger funds. And we want to benefit from that thinking, from that thesis. And I'm doing this now for 12 years, invested in more than 50 funds, most of them in the European ecosystem. That's in short.
So yeah, that's a very interesting direction, I would say, because I usually, talk with VC managers that are, trying to understand which is the best startup to invest on, but you are trying also to understand which is the best fund to invest. So one of the most common questions that I ask them is, how do you choose a startup? So I would like to do the same for you, but for VC. So how do you actually choose a VC to invest on?
So maybe one step ahead, or one step before. I started investing in funds when there were literally 50 or 60 a year. So I looked at 50 or 60 funds to decide to invest in 2 funds per year. We are currently in an ecosystem where in Europe, if you look at across Europe, there are roughly around 1,000 new funds coming from. So instead of screening 1,000 startups, a fund like us is screening a similar number of funds today to invest in. We invest in 10 funds roughly per year. So we select 10 out of roughly 1,000 that comes through our pipeline. So the question, most people or most VCs try to invest into or screen a deal flow of 1,000 companies. For us, it's a very similar one. Because we are screening the whole VC deal flow across Europe. I think that's sometimes misunderstood, because it's not like that there are much fewer VCs in the market than you can just, VC investing is a much easier thing to do. If someone really wants to do it in a professional way, you have to go into markets like Finland, Sweden, Denmark, but also Portugal, Spain, Italy, and screen all the VCs that you find. And only then you can make a real decision on where to invest in. It's the same as if you are a fintech investor, for example. You ideally have to screen all the fintech startups across Europe, if you're a European fintech investor, to decide on which ones you take into your portfolio. So that's maybe a big difference. And to your question, so for us, selection is, again, some selection criteria is mainly based on hard facts like fund size. So if you are a 100 million fund, it's an easy no. If you're a 200 million fund, it's an easy no. If you are a multi-stage fund, it's an easy no. If you are a pan-European generalist, it's an easy no. If you're a specialist in a small region, let's say hardware in Switzerland, it's an easy no. So lots of easy no's for us, right? So clear no's. So what we typically look for is what we call either a local winner that is a generalist fund in a very specific region where you cover that region and are considered the go-to GP in that region. That can be in UK, that can be in Germany, that can be in the Baltics, etc. The other focus that we have are pan-European specialist funds. So either you're a local winner or you're a vertical winner. And as a vertical winner, let's take the fintech example again. We would like to back someone who is considered the go-to GP in fintech across Europe. So if you're a fintech founder in Lithuania, who do you speak to ideally? If you're a fintech founder in Portugal, who is your dream VC? So if there is something like that, and several times you don't have that. In both cases, you don't have a local winner and you don't have a vertical winner. But if there is a clear vertical winner or a local winner, that's the one that we would like to take in the portfolio. Now, if you take UK as an example, there are several local winners. It's not one. So we still have to make a decision amongst those local winners. But the hard criteria reduces our deal flow a lot. So we focus on maybe 100 a year and do 10 investments in those.
So when it comes, let's say, to regional champion or specific region, like for example Italy or Spain, I would say the decision is quite easy. Let's say rather easier than other countries because the number of VCR is lower and everything else. But when it comes, and you made a good example to the UK, for example, how do you actually choose when you have multiple VC that are fitting, the right description? It's mostly the team, the managing partner. What are the main?
So one part is objective criteria and the other one is subjective. So it's in the end my decision on who I think I would like to work with. And that is something that it's not quantifiable. So you can't say because of that and this, I'm choosing to work with XYZ. It's so if you have several inner markets, and I don't agree that it's easier to invest in Spain because most cases, for example, Spain is a good example. We don't have a clear local winner. So there is not a local winner. That's one of the markets. Same for Italy. There was never a clear local winner in Italy. I think the market in Italy develops in the last 1 or 2 years. Before that, it was
I totally agree with
black
this one.
hole for VC funds. So sometimes it's good to have several local winners and to make one decision. And we're not always right. That's also very important. Like a VC fund is never always right. You invest in 30 companies in a fund and you have maybe 5 to 10 good companies at best and maybe 1 or 2 real outliers. It's very, very similar for us. So, okay, we have no write-offs, right, as a fund. So most funds will still return some money, but most of the funds will be what we would call average. A few funds will be outliers. Now, those outlier funds, because of our focus on small funds that invest very early, the outlier returns are higher or better or clearer than in any other larger VC fund. So I think that's our bet, to have the real 10x funds potentially in our portfolio. And if we have that, then the average of our return becomes still very attractive for the risk that you are buying. Because a fund of fund is more or less eliminating the risk in venture because of the diversification, right? So we have 1,000 companies in each portfolio. If you are invested in 1,000 companies, which otherwise is almost impossible to do. So for most individual or institutional investors, it's almost impossible to build a 1,000 startup portfolio if you want to invest direct. And even a portfolio of 30 funds is relatively, I would say, challenging for most investors. So we are like an allocation bet on VC to reduce or eliminate the risk and still have some kind of upside because we're investing in micro VCs.
A positive, let's say, a very interesting point here is the one about returns. So there were recently a lot of studies and reports about the average reports that VC are making, and I saw the exact same data that you saw. Basically, smaller funds are returning a bigger amount of money compared to bigger funds and everything. So I wanted to understand what's your expectation under that point of view. So if you invest in a micro fund, for example, what's your expectation in terms of return, and what's the kind of return that you expect? Maybe you expected in the past in larger funds, for example.
So larger funds, in our opinion, and venture are, because of their fund size, kind of limited. So even if you have a unicorn in your portfolio, in most larger funds, that unicorn doesn't even return the whole fund. So returning a whole fund means you have one outlier company, and if you exit that company, is it returning one time the fund? And the larger the fund, the lower the probability that this will happen. So you need several unicorns to even return the fund.
The amount of money.
One time. Now, if you are a very small fund that invests very early, where the price is lower for the company, and if you have an outlier, then this is realistically can lead to 5 to 10x returning a fund, in total. So this happened in our previous portfolio, and we so believed very early on that this can happen. Now it happened, so it's more like a proof that this happened, and we think it not only happened once but several times now. The longer we are in the market, the more visibility we have in our own portfolio, which again is for us like a proof point that the model that we choose seems to work well, right? So in terms of returns, our expectation is always relative. So what does it mean? Relative to the market, right? So whatever the market is returning in the next decades, we are trying to optimize the returns on the upper returns. We call it upper quartile or upper decile, whatever you call it. But we think that we will hit whatever that upper quartile will deliver in that market. And that's why it's very difficult to say, we are a 3x or 4x or 5x fund. It really depends. If the next decade is a super strong decade, we might be a 5x fund. If the next decade for venture and tech is a very, very bad decade, we might end up a 2x fund. But that's the most outcome that would come out of that market. So I think in general that venture, if it works, is returning on average in general. So I'm talking about the better returns, returning better than every other asset class by nature. Why? If you invest in private equity, you invest in an established, mature company.
Yeah.
So the upside in an established, mature company is, of course, limited, right? So your target is, on average, I think 3x, 4x, 5x the company, if it's a successful exit. Now, in venture, early stage, the target of a successful company is like a 300x.
Yeah.
So it's a very different outcome. Of course, you have also several write-offs and several companies that don't work. But if you have in your total portfolio several of those outcomes that work well, then venture will definitely be performing better than every other asset class. It's impossible that real estate, a diversified real estate portfolio versus a diversified venture portfolio, it would be like, it's impossible technically that a real
to
estate
compare the two. Yeah.
Will outperform a venture portfolio. So the whole thinking about a venture portfolio was and is, by most institutional or larger investors, there is a risk behind it.
Yeah.
Now we think, or we argue, that the risk with diversification goes away. So if you can reduce that risk in venture by diversifying in the asset class, so then you have similar volatility or risk like in a real estate portfolio, I would say, and that's the beauty of a fund of.
Oh, it's an interesting concept, and we always argue, about these kind of things, and mostly about the topic of risk and having lesser risk. I think that one of the most current and argument about the VC capital, mostly in Europe, is the kind of comparison that we have between US investors and European investors. So we always get the question of why we are not ambitious under that point of view, and why US funds are, funding startups that are always a moonshot. So do you see that kind of change in mentality between US funds and European funds? I know that you focus on Europe, of course, but you have a broader experience under that point of view. So do you actually see that kind of change in mentality between the two kind of investors?
So first of all, US investors love the term moonshot. So all moonshot investors. And I think in venture, you need this moonshot to justify or to achieve these huge returns. So everyone is looking for that moonshot. Now the question is, do moonshots exist in Europe? Are they created here? And I think the creation of moonshots today is a very democratic thing that happens everywhere in the world. It happens in Asia, it happens in the US, it happens in Europe. If you think about LATAM and the neobanking, then you have one of the most successful, most profitable moonshots ever in the whole banking industry, fintech industry in the whole world. So I think what we see and what we believe in is that the creation of technology, especially in Europe, with all the talent that exists in Europe, is a natural thing. So technology will be created in Europe. The next question is, how do you benefit, and who are the most benefiters of that technology or creation? So I think in the earliest phase, it's still European investors. But at the moment, the later the stage goes, the later the round goes, the more institutional investors from the US come into those European companies. And in most cases, the European companies even swap into a US entity. So they're considered a US company at some point.
Yeah.
So one of our biggest outlier in our total portfolio comes out of Romania. So it was created, founded, the first investors were Eastern European VCs. So it's the biggest outcome for us. It's a Romanian startup. But if you look into the books and the data, today it is considered a US company. Okay. So the US investors say we invested in another US unicorn or techicorn. But it was created in Europe. And I think that is completely underestimated. That's our work. So we are investing at the earliest stage with small funds from the European ecosystem, benefiting from European talent, benefiting from European valuations, benefiting from a very fragmented, difficult to access, intransparent, inefficient market, which is not easily accessible from SF or from New York. So at the earliest stage. So that's where we buy. So you buy at a lower price. You buy into great teams. You spend less. Not only you buy at a lower price because the companies need less money because they spend less compared to, let's say, SF. So the creation of the technology happens in Europe.
Here. Yeah.
But then I don't have a problem if the next investor is a huge US fund coming in. It's even a benefit for us. I don't have a problem if the company is exited to a US company or does an IPO in the USA. So that's all benefits for us. So we're benefiting from the exit stage and the follow-on money stage, but we're benefiting at the same time from entering the companies at the lowest level in Europe. So that's I think our business, and that's why I think Europe is still completely underestimated at the moment, but very still when it comes to tech creation.
That's also a very recent argument. Recently we had Klarna that is going to list on the Nasdaq, so basically in the US. Revolut that is probably going to be listed sooner or later again in the US, and that was one of the main complaints that were made to them. Okay, you are, let's say, European companies, even if the UK is not Europe, you are European companies, but you are all going away to make an exit or to make a listing. But if you take a look at the data, this was something that they came out recently. London, that was once one of the major financial hub in Europe, didn't had any new IPO in the last couple of years, and it was behind places like Uganda or Morocco in terms of new IPOs in the stock exchange. That was a shock for many people. So that point is very, very valid. I mean, a company that has been born here and that has been building here and that goes away to make an IPO is still, in my opinion, an European company. It still counts under that point of view.
So I was at a summit of a large fund of fund in London 2 days ago. And I watched a presentation from Morgan Stanley. Was one of the big, IPO banks, investment banks doing IPOs, helping on IPOs. And it was very, very interesting insights on the IPO market. First of all, it seems that the IPO data for Europe is not as bad as people think, and especially for European companies. There is something like a dual listing. So you can list in the US, but at the same time, you can also list in Frankfurt or London, which is, in my opinion, kind of a benefit for a European company because they can benefit from the buyers in the US by listing in the US, but they can at the same time list the same company in London or Frankfurt or any other exchange here in Europe as well. And by that, have access to both markets in terms of selling the equity. But in general, so I'm talking basic here. So if I have a company in my portfolio and the best outcome for the portfolio and their investors and the founders is to list the company on the Nasdaq, it does not mean that it goes away. So every European investor who is interested to buy that stock can still buy that. It's not like limited to US investors or something like that. So every German investor or every Luxembourg-based investor, if they are interested to buy any Klarna stock and Klarna is listed in the US, it's accessible. So they can still own part of the company. The best thing for the company is still to list wherever you get the best price, the most visibility, to list your stock and trade your stock. So for me, it's just a very, very natural decision to make an IPO in the US if you can, if you are large enough. But at the same time, it's not limiting any other investor from Europe to participate in that IPO. So I never understood that term, the company goes away and is listed somewhere else. So it's a market where you list your stock, but the stock is still owned by the investors. And if the investors, let's say, are European institutions, so decide to invest in that company, then it's owned by European investors and the company is listed in the US. It doesn't matter.
In the end, it's a free market.
It's a free market. And it's thankfully a free market, which is a good thing also for European companies. Imagine European companies could not list in the US. Imagine they were not allowed. That would be a problem, I believe. That would be a problem. But we are able, if you're strong enough, to list in the US, and every European investor is able to buy the stock in the US. So what's the problem really? It's not an ownership problem in my opinion, because we're not denied ownership. If it's, I think the whole discussion in Europe is about, companies go away and we lose ownership in those most relevant companies now coming out of Europe. You're not losing anything. You can access the company. You can do the Series A, B, C round if you're competitive enough when the companies are private. And you can access, and it's even more democratic, you can access the company when they are listed in the US. No problem to build ownership from Europe in a US company.
Yeah, I agree on this point. Maybe
And one sentence: listing the company in the US does not mean that the operations of the company are in the US.
Of course. Yeah, most of the time it's not. Also
exactly.
taking in consideration the cost
Exactly.
of owning that structure. I wanted to deep dive a little bit on the last, let's say, 2 years, and on the next two, I would say. So the last 2 years, mostly in fintech, but overall, I would say in the startup ecosystem, they were challenging in terms of funding and everything. So raising money was harder in certain sector. In other were easier, but let's say it was harder. But the kind of common gut feeling that I heard from a VC investor is that 2025 could be the year of liquidity events. With more people, more companies making IPO, more mergers and acquisition, more money coming back to the VCs in terms of returns, and they can spill the wheel again. Do you actually think that, first of all, if we need that kind of liquidity events, and if 2025 is going to be that year?
So last question, to answer your last question first, yes, of course, we need liquidity events. So very clear.
Yeah.
When you compare today's markets, not 25, but today's, let's say, the relatively weak market to 2021, which was a peak market.
Yeah, Q3 2021, I think it was a peak. Yeah,
it's a total peak of the last decade.
Yeah.
So of course it looks weak. If you compare 2024 with 2017 or 18, it's still okay.
Yeah.
And as an investor in a diversified portfolio, we are not trying to time markets. So whether we invest into companies, we try to invest every year into the same number of funds and same number of companies roughly, because we don't know when the right companies will be coming into our portfolio. Same as for the exit. I think we're not. It would be great to see some exits next year, of course, but it's not timing the exits. It's about when the right time is for an exit. So if 25 is not the right time for most of our companies, that's fine. We'll wait 1 or 2 or 3 years longer until we find the right time to exit the company. And I think that's more important. And to give another example, also last year we had one of our largest exits in the German ecosystem. It was, I think, the only or the largest unicorn exits trade sale in the German ecosystem in one of the weakest IPO and exit times. So this was a strong returner for the fund. It was a strong returner for the fund of fund. It was a great sign in the markets. It didn't happen a lot, but it can happen. So it happens even if the market is relatively weak, that these kind of exits happen. Of course, we all wish, and this is a very cyclical thing, that some years are much stronger than others in terms of IPOs or exits. You can argue that a lot of companies in the US who are listed have deep cash reserves to buy companies at the moment. It's probably a good time to buy strong companies at the moment because you wouldn't pay the highest price.
Yeah.
So I think probably it's a good start in 2025 with exits. I would say it's probably a higher probability for liquidity in 2024. Do I know if it's 2024 or 26? I don't know.
No,
it could
of course.
be so shifting to 26 or 27 even. It's not. We don't think it's super important on when. We think it's super important that we have exits or exitable companies, and that you achieve the best possible exit price. So, if you wait 2 years and receive a 5 times higher price for your exit, it's worth waiting 2 years for that company. If you see like the best price coming in next year, yes, you sell it.
Yeah. Oh, it's very interesting. I think that liquidity events are critical for this kind of industry, and we will always need them. An argument that I recently heard a lot is the fact that maybe we also need a different kind of venture model. So for a long period of time, we had good returns in ventures. Then the last 2 years were tough, as we said. Do you actually believe that we need a different model in venture capital, or do you actually think that it's just the actual feeling, coming from 2 years that were a little bit tough?
I mean, we had one of the strongest decades ever in Europe, and
that's a good point.
Also in the US.
Yeah.
It's one of the strongest decades, the last decade, just because we saw like a cyclical, change in the last 2 years is, for me, not really a bad sign. In fact, it's a good sign in general because we start buying again at very low or relatively lower valuations compared to 2021 and 22. So it's also, if you're buying at a lower valuation, it's also a good sign because the exits will come in 5 to 10 years. I personally don't think we are in a bad market. I think we are in a relatively strong market. If I look back at the last 10, 12, 15 years, I think we have many more funds investing today, many more GPs who are professional and educated and experienced today, many more founders who are serial founders who founded or worked in strong tech companies and now are going back and found themselves. So the quality of founders increased, the quality of VCs increased, the number of VCs increased, the number of family offices investing into venture increased. So all the signs are, in my opinion, relatively positive. And probably what many people forget is, when we talk about VCs, let's say we're talking about micro VCs, it's a lot of small funds. But if you think about the late stage VCs and the multi-stage VCs, if you think about the Sequoias and the Costlas of this world, they raised multi-billion-dollar funds in the last years. So they are still sitting on dry powder that is several billion dollars inside one of the largest late stage funds. I think the previous fund was a 4 billion or 5 billion fund, and the latest was a 20 billion fund. So the 20 billion has to be deployed. This has to be, this is dry powder going into the market. You need huge rounds to deploy the 20 billion. We're just talking about one single A16Z and recent Horowitz raised billions.
Excel the same.
Yeah. So all of them, exactly, Excel, and all of them, they raised huge amounts. And there's even this data, the statistics that the bigger funds get even bigger. And institutionals are putting more money into the bigger funds, the brands, instead of, all the small funds where we are focused on. So what I'm saying is that all these funds were raised. They have all money to invest into strong tech companies. On top, it comes the private equity industry that opens more and more into tech. So more and more private equity funds who raised even more capital and sit on more dry powder have to deploy that money at some point. Otherwise, LPs will say, we gave you money, you collect management fees, but you don't invest the money. So I think that a lot of dry powder still sits in a lot of funds that has to be deployed at later stages. So I think personally that any strong tech company today with strong credentials raising a later stage round has no problems to raise globally a later stage round. There's enough money currently in the markets for strong companies. And if you look at the earliest stage, just because of the high number of VC funds at the earliest stage, I still think it's much easier to raise capital today compared to 10 years ago.
The last one that you were mentioning is a very interesting trend, in my opinion, and I saw that happening recently. More and more private equity funds are, let's say, entering in the venture capital landscape, trying to acquire good companies that are maybe not in a good position, so startups that are not able to raise a new round and everything else. Do you see them more as a competitor to VC or more as a partner under that point of view?
I don't see private equity funds as a competitor. I think the later and the larger the rounds are, the more diversified the pool of capital is. From sovereign wealth funds, private equity funds, VC growth funds, and family offices, so larger groups of investors. Even like a Goldman Sachs is going into a growth round, probably putting up a feeder for their clients. So it's very, very diverse, the pool of capital that is going into that area. Private equity, by definition, is not a tech investor, in my opinion. And but there are several tech companies who are highly profitable. So they are a private equity case. And those companies that are profitable, strong, growing companies, this is a private equity case. And of course, private equity funds will be a competitor for those companies in terms of supply of capital.
That's a very nice touch. Maybe last question, because our time is running over. Let's suppose that someone come to you tomorrow that has maybe a solo person, a solo GP with a micro fund that check all the right, marks under your point of view. Which are the main variable that you are looking for in a new VC, in a new managing partner in a VC? So what are you looking for in that person to be one that you could potentially invest on?
I mean, I mentioned a few things, and most of the things, if they check all of the boxes, there is one simplification or breaking down on what really matters. Are you one of the leading thought leaders in your either geography or vertical? And would you consider yourself a go-to GP, a local winner or a vertical winner? And if that's the case, then the probability for us considering an investment is much higher. Now, if you don't have a clue, if you are, then you're not ready, in my opinion. And it's not easy because it's a very competitive market today. So you have lots of funds who claim to be a great fund in their area. And it's very difficult to be considered a top fund by founders and by other VCs, right? So that's the checkbox, the last checkbox that we need to make for ourselves. Do we believe that these are considered that this fund is considered a top fund in his area? And if that's the case, then it's a relatively then it's an easier bet for us. If you are considered the top person in your region or in your vertical by others, means by founders and by other VCs.
So it's an external validation under that point of view.
Yes, I would say until we make a decision. So, and our decision is then very subjective personal decision. If there are, let's say, several, then it would be still like, who do we like most? Who do we think is the better investor?
Okay. Well, this was a very, very interesting conversation. Thank you very much for joining, and I wish you the best in your acquiring.
Thank you very much for having me.
Thank you.